Double top and double bottom patterns are very similar to the previous form, and if you understood the principles of trading with head and shoulders pattern, this will not be a problem. Double top and double bottom patterns, in addition to indicating a potential trend reversal, as the previous pattern, also provide a signal for precise entry into the position with a clearly defined stop losses and targets. Double top is usually at the top of the growing trend or a particular wave in the growing trend. The shapes of this pattern looks like the letter M and consist of two peaks that are almost the same height. Of course, these does not have to be at identical levels, but it's desirable to be about the same levels. And it is important to mention that the right top should not exceed the left top. The assumption behind this pattern is as follows. In the market, there is always a relationship between bull and bear traders, and when the ratio is on the bull side, or when buying exceeds the sale, it comes to growth of the traded financial instrument. On the graph, this situation appears when we notice a higher peak than the previous. When double top pattern appears on the graph, or when we see that the last peak wasn't exceed the height of the previous peak, traders believe that bull traders lost their power and there will be a trend reversal. Now a growing number of traders take the bearish side and push the price down. It is considered that sales exceeded purchases when price breaks the level of previous bottom. Previous bottom is marked with a red horizontal line, called the neckline as the previous pattern. The break of this line is a signal to sell and our entry into the position. At this level below the neckline, panic orders can be set. We explained them in the first part of the course, so that the platforms automatically activates position when it comes to breaking of the neckline. Of course, this entry should be set up a few pips below the neckline, not directly on it, because it is necessary to wait a clear breakthrough of previous bottom. Stop loss is always placed above some resistance in a growing trend. In this case, the only relevant resistance are the two previous peaks. So we should set a stop loss a few pips above them. As far as targets are considered, we can determine them in several ways. The minimum profit you can expect is the level of the neckline pattern to the height of the previous peak. This level is indicated by a black vertical line. Since the price can often fall more than this level, you can use a trailing stop by moving your stop loss at the level of entry into the position when the price falls to the level of the first target. Then you have a trade without risk. If the price continues to fall and falls for another length of the target, it is approximately this level here, you then move the stop loss at the level of the first target. In this situation, you ensured a profit and you can continue to move the stop loss according to the movement of the price. Now we can move on the double bottom pattern. Double bottom is in fact a reverse double top pattern. As a rule, should be located at the bottom of a decreasing trend or a particular wave of the decreasing trend. The shapes of this pattern looks like the letter W and has two bottoms which are on the almost the same level. In this pattern, it is also not necessary for the bottoms to be at identical levels, but what is important is that the right bottom should not be lower than the left. What can we conclude based on this pattern? Firstly, we can conclude that since it is at the bottom of a trend or a particular wave, we have a situation in which the sale exceeds the purchase of the observed financial instrument. This situation causes a drop in the price of the financial instrument, and on the graph we can see that by noticing that the price constantly forms the lower lows. But the price forms a new bottom on the graph which could not exceed the previous. It is considered that bearish traders lose the strength and there could be a reversal in the price movement. A sign that bearish traders are losing strength is the impossibility to break the previous bottom. A sign that bull traders becoming superior are exceeding the level of the previous peak. A break of this level gives a signal for buy. Enter into a position should be made a few pips above the previous peak. As we said at the double top pattern, it is useful to set the pending orders so we wouldn't miss the entry due to a sharp jump in prices. Stop loss is placed a few pips below the double bottom patterns, while the take profit is set as in a double top pattern, meaning that the minimum target is the length from the previous bottom to the level of the neckline. You can also move the stop loss in case of jump in the price to the level of the first target and then move again if the price continues to rise, because the price can often make a big reversal after this pattern. Now we'll move on the platform. We'll show the currency pair Australian dollar US dollar on H4 or H1 graph. The first thing we notice on the graph is this drop down wave and then double bottoms, which are at the same level. We'll mark this level. The next thing we see is the previous peak, which indicates the level of the neckline. We'll mark and this level. What did we say? The first entry is made a few pips above the neckline, which means that we would set pending orders for buy at this level here. While stop loss is set a few pips below the previous two bottoms, which is above at this level here. Target is set at the level of the height of the patterns, and it is at about the level of 0.7167. If the price reaches this level, you can close the position or move the stop loss to the level of entering into position, and then you have trade without risk. Then, if the price continues to rise and reaches another target, as it happened, we moved stop loss to the level of the first target. Then we ensured profit, and we're waiting for another growth. Or we can set our target at some level of resistance, for example, a significant peak or something similar, and there close the position. Another example is the currency pair Australian dollar Japanese yen on H1 graph. We see a double top pattern. We'll mark the level where there are two peaks and the neckline. A few pips below the neckline is the right place for entering the position. It is this level here. We see that the price broke through that level, then made a smaller return, and then started in the right direction and made a huge fall. Target is, as we said, pattern's height, or the other option is to move the stop loss and expecting a higher profit. We can notice the double bottom patterns on the graph, which was formed before the double top pattern. We see two bottoms at the same level. We'll draw the neckline, and if you measure the growth after the break of the neckline, we see that the price has reached the level of the first target, which means that almost in the 1 or 2 days of price movement, we have two winning patterns on a single currency pair. After the trend reversal patterns, we'll explain a trend continuation patterns. The trend continuation patterns, as their name says, indicate a continuation of original trend. We will talk about three formations of trend continuation: triangles, rectangles, and flags. As with previous patterns, these patterns also provide signals with defined levels to enter the position, as well as levels of stop loss and take profit. The first patterns that we will talk about are triangles.